Welcome everybody. So this is probably only mine and Sean's favorite topic, tax. I've been practicing tax for 21 years, both in accounting firms and in private practice, and have developed both love for the subject matter as far as its technical difficulty, but also the ability to be able to work through complex issues and find solutions for my clients, both in Canada and internationally. So I'm going to share my screen now, just one moment. Okay, here we go. I'm sorry, 1 second. Okay, can you all see my slides? Okay, perfect, thank you. So I'm going to speak about the tax considerations of carrying on business in Canada, and we will start, okay, we've already heard about me, blah, blah, that's my contact information. And of course, the requisite disclaimer, this is not specific legal advice, and of course, we are happy to assist you with specific legal questions. Okay, so I'm going to speak about, I mean, you know, I could talk all day on tax there. I mean, even one of these subjects is potentially the subject of its own full day presentation, but to avoid boring you and also because there's not that much time to cover everything, we're going to hit the highlights of these particular areas. So we'll start with the jurisdiction to tax. So we have 3 different jurisdictions for tax in Canada. We have the federal level, which is income and excise tax. And then we have provincial tax, which is payroll tax, and municipal tax, which is primarily real estate property taxes. So I'm going to speak a little bit about the basis upon which tax is levied in Canada. And the application of income tax is based on residence. So residence is generally a question of fact, and although there are a few specific rules. So for example, a corporation is deemed to be resident in Canada if it's incorporated in Canada. It's pretty straightforward. However, a corporation that's incorporated outside of Canada may still be considered resident if its central management and control is located in Canada. So we'll get to these issues later. I just want to highlight to you that notwithstanding that you are perhaps a foreign entity carrying on business in Canada, you may be considered to be a resident of Canada in certain circumstances. If you are considered a resident of Canada, then you're taxable on your worldwide income from every source, and that includes business income, property income, investment income, and capital gains. Now, excise taxes are a value-added tax. In Canada, it's called the goods and services tax, and I will be speaking about that as a separate topic a bit later on. And the GST rate is 5%. Provinces levy their own sales tax. In Ontario, the GST is harmonized with the provincial sales tax so that there is a 13% combined tax for goods and services, taxable goods and services in Ontario, and that is imposed at the place of supply. So the GST is imposed based on the place of supply of the taxable good or service. And then payroll taxes are employer and employee contributions toward Canada Pension Plan, Employment Insurance Plan, and employer health tax in Ontario. And I will be speaking about those a little bit later on. Okay, so we just talked about that. Just by way of refresher, these are the main forms of business organization that Taras just spoke about. So I'm going to be going through them all relatively quickly, at least the first 3, and then focusing mostly on the taxation of a branch and a subsidiary. So as Taras spoke about, sole proprietorship. So there is his slide from before. And with a sole proprietorship, essentially there is no distinction between the individual and the business. And from a tax perspective, the income that is earned is going to be taxed in the hands of the individual sole proprietor, and business expenses can be deducted from the business income. And again, as Taras indicated, this is likely not going to be a form of business organization for the majority of you here on this conference. So next we have a partnership. So we have general and limited partnerships. Again, this is Taras's slide from before, just as a refresher. A partnership is essentially a flow through for tax purposes. So partnership income does not get taxed at the partnership level, but rather it's flowed through and is taxed in the hands of the partners in their respective proportions of their partnership interest. Okay, next, a joint venture. Again, this is Taras's slide from before. A joint venture is not a recognized distinct legal form of business organization in Canada. It is simply an arrangement where two or more parties share in a common venture. Usually there is a contractual relationship that will outline the nature of the relationship between the parties. But like a partnership, profits and losses are not calculated at the joint venture level. They are paid, taxes are paid at the individual co-venturer level, and taxation is therefore, profits and losses get flowed through to the individual co-ventures, and taxes are paid at that, at their level. All right, so now we go to a branch, and this is where it starts to get much more interesting. So a branch is not a separate legal entity. A branch is essentially an outpost, if you will, of the parent corporation. And so as a consequence of carrying on business in Canada, all of the debts, liabilities, and obligations of the Canadian operation will be attributed to the foreign corporation. And a Canadian branch of a foreign company will be, is treated like a Canadian resident. And the foreign corporation will be subject to federal and provincial law and must obtain a license or otherwise register in all provinces in which it carries on business, which Taras spoke about. So one of the issues, just going back to my previous discussion about residency, is determining whether a branch is resident of Canada through a permanent establishment. As in almost all things tax, determining whether a Canadian permanent establishment exists is a question of fact. Generally, a permanent establishment is a fixed place of business through which the business of the non-resident is wholly or partly carried on. Tax treaties can generally provide that a permanent establishment includes a place of management, a branch, an office, a factory, or a workshop. Depending on the nature of its activities, a branch operation will often have a permanent establishment in Canada. A permanent establishment can also arise in other circumstances, such as through computer equipment. The CRA considers computer equipment, such as a server, to be tangible property having a physical location. And as such, a server may constitute a non-resident's place of business if it is owned or leased and used by the non-resident. On the other hand, the mere use of a computer or server owned by a third party will not generally constitute a fixed place of business. So as you can see, so far, there's an it depends quality to all of this, which is, again, not surprising in the tax realm. Another potential way that a permanent establishment can be created is through agents and employees. So if you do not have a fixed place of business in Canada and that you don't have a bricks and mortar location, and by the way, that is a very common mistake, that it is thought that you won't have a permanent establishment in Canada if you don't have an actual bricks and mortar location. With the rise of e-commerce, and as we saw with the CRA considering a server to potentially give rise to a permanent establishment, it is not realistic to assume that if you don't have an actual location, physical location in Canada, you don't have a permanent establishment. We can see also that as I was just discussing, an agent or an employee may constitute a permanent establishment of a branch. And that could be if the person has and habitually exercises authority to conclude contracts in the name of the non-resident. So again, you have to be very careful as far as the nature of the relationship that you have in Canada, and whether you're sending employees to Canada, whether those employees could A, themselves be deemed to be Canadian residents, and B, potentially constitute a permanent establishment for your organization here. Now, there is some relief under treaties, and I will be speaking about treaties just very briefly later on, but I do want to reference the Canada-US tax treaty here, because there are some, now we have a special relationship with the US, and there are certain provisions in the Canada-US tax treaty that don't apply to other treaties or haven't been extended in other treaties. However, under the Canada-US tax treaty, if a U.S. enterprise is providing services in Canada and is not otherwise found to have a permanent establishment in Canada, it will be deemed to be providing services in Canada through a permanent establishment if the services are provided by an individual who's present in Canada for an aggregate of 183 days or more in any 12-month period, and more than 50% of the gross active business revenue of the enterprise is derived from such services, or the services are provided in Canada for an aggregate of 183 days or more in any 12-month period with respect to the same or a connected project for customers who are either resident in Canada or who maintain a permanent establishment in Canada. Again, without going into too much detail here, as it is very fact specific, as a general rule of thumb, the 183-day rule can create both a permanent establishment and a fixed base and deemed residency in Canada. The 183 days is not calendar days. It is rolling 183 days based upon the actual period of time spent in Canada. And there was a change several years ago to the calculation and the counting of days, and even an hour spent in Canada, a part of a day can constitute a day for the purpose of calculating the 183-day rule. Okay, so what is carrying on business in Canada? Well, non-residents are deemed to be carrying on business in Canada for the purposes of the Income Tax Act if they produce, grow, mine, create, manufacture, fabricate, improve, pack, preserve, or construct anything in Canada in whole or in part, whether or not it's exported. You solicit orders or offer anything for sale in Canada through an agent or servant, whether the contract or transaction was to be completed inside or outside Canada, or partly in and partly outside of Canada, or you dispose of certain Canadian real or removable property situated in Canada. So that is deeming provisions in the Income Tax Act with respect to what constitutes carrying on business. So if you are deemed to be carrying on business in Canada, in addition to federal and provincial income tax and potentially excise tax, there is a branch tax. So branch tax is a tax of 25%, and that may be reduced by an applicable tax treaty. And that is levied on after-tax business profits of a non-resident foreign corporation that's carrying on business through a branch, rather than as a separate subsidiary corporation. Many tax treaties also, so in addition to potentially reducing the amount of branch tax, many tax treaties also provide that the first $500,000 earned by a Canadian branch operation of a non-resident company is exempt from branch tax. So the amount that is subject to branch tax is the earnings of the branch less the following: business losses in previous years, Canadian taxes on the profits other than branch tax, profits reinvested in Canada, and a deduction of $500,000 Canadian. So the branch tax is intended to approximate the Canadian withholding tax that would have been paid on a dividend paid by the Canadian resident subsidiary to its non-resident parent. In other words, if on a repatriation of profit, that 25% withholding tax, which I'll be talking a little bit more about later, is the amount of branch tax. That's what branch tax is attempting to replicate, the tax that otherwise would be payable on a repatriation of profits. Now, why operate as a branch? So a branch is not a separate legal entity. So the financial and tax accounting for branches may be more complex than for a Canadian subsidiary. So that's something to think about on a filing and reporting, from a filing and reporting perspective. But generally, non-resident companies operate as a branch in Canada if they expect startup losses in their Canadian operations, because such losses can then be consolidated against profits of the non-resident corporation. And in addition, the first $500,000, again, subject to treaty, and assuming that there is an applicable treaty in place, that first $500,000 would not be subject to branch tax anyway. So it would make sense to operate as a branch if A, you anticipate startup losses, or B, you anticipate that your net income will not exceed 500,000 Canadian dollars, and therefore you won't have a branch tax obligation. The risk, of course, of carrying on business through a branch is that you will have assets and liabilities of the parent corporation potentially subject to claims with respect to Canadian operations. So there is no separate limitation of legal liability with respect to the Canadian operations and operating through a branch. Now, it is possible, and this I have had this happen in multiple occasions, where people start off operating as a branch, and then they decide after a few years that they want to convert their branch operations into a Canadian subsidiary, because they've now potentially gotten to a point where they have permanent employees, or they have they're getting to the point where they're exceeding that $500,000 branch tax exemption threshold. So you can convert a branch to a corporation on a tax deferred basis in Canada once operations become profitable and the $500,000 threshold of earnings has been reached. Now, there are withholding tax obligations of a branch, and so if it receives passive income, such as rents, royalties, or interest, then the payer of such passive income will be required to withhold and remit to the Canada Revenue Agency non-resident withholding tax. However, if the income is attributable to a Canadian permanent establishment, it will be exempted from withholding tax, but it will instead be subject to Canadian income tax. The main two advantages to using a branch are that any Canadian business losses incurred by the branch would likely be deductible against income earned in the foreign jurisdiction, and therefore reduce overall tax payable by the non-resident. And second, the non-resident corporation can generally claim foreign tax credits for any Canadian income taxes paid in connection with the operation of the branch. Where a corporation is carrying on business through a Canadian branch, all of its books and records with respect to the Canadian operations must be kept at its Canadian place of business or other designated place, and must also be made available for audit by the Canada Revenue Agency. Non-resident corporations who are carrying on business through a branch face the potential problem of preparing financial statements for the branch that also are acceptable to the Canada Revenue Agency. So there is a filing, reporting obligation and a financial statement obligation of the parent corporation in Canada that has to be considered when one is operating through a branch. Okay, so now moving on to a subsidiary. So a subsidiary, of course, is a separate Canadian corporation, as Taras has mentioned. It is taxable on its worldwide income, and it is subject to both combined federal and provincial tax rates. Sorry, just 1 moment. Okay, so under the Income Tax Act, the taxation of a corporation will vary depending upon the jurisdiction of incorporation, the type of corporation, the type of income, and activities carried on by it. And as I indicated, it is taxable on its worldwide income under Part 1 of the Income Tax Act. As previously mentioned, a corporation is deemed to be resident in Canada if it's incorporated in Canada. So where you have a federally or provincially incorporated corporation, it's going to be deemed to be resident in Canada by virtue of its incorporation. So combined federal and provincial tax rates, they vary between 26 and 31%, depending on the province or territory. And that's for active business income. We talked about withholding tax again, because withholding tax still is going to apply with respect to payments that are being made to non-residents of Canada. So those include dividends, interest, rents, and royalties. So with respect to dividends, the Income Tax Act generally imposes a 25% withholding tax on dividends that are paid by a Canadian subsidiary to its non-resident shareholder. Now, this rate may be reduced by tax treaty. For example, under the Canada-US tax treaty, the rate of withholding tax on a dividend is paid by a wholly owned subsidiary to its parent may be reduced to 5%. Paid up capital can be repatriated from a subsidiary to a parent free of withholding tax, even if the subsidiary has undistributed earnings and profits. Management fees, rental, and royalty payments are subject to a 25% withholding tax. So if the parent company provides management or other administrative services to a Canadian subsidiary, if the Canadian subsidiary pays management fees to the non-resident, the management fees would be subject to withholding tax unless they represent a reimbursement of specific expenses. Now, without getting into this because it's too technical an area to discuss, intercompany charges are subject to transfer pricing considerations. And so you have to be careful. It's not enough to just say, well, it's a strict reimbursement of expenses. Sometimes that's not sufficient from the perspective of setting up your intercompany charge protocol. And so you have to be mindful of transfer pricing with respect to those sorts of things. Management and administrative fees that are paid are generally deductible from income of the Canadian subsidiary corporation. And it's important that the basis for any management and administrative fees charged is properly documented in accordance with the provisions of the Income Tax Act. Otherwise, significant transfer pricing penalties could be applicable. So one of the tools that is often used is something called an advanced pricing arrangement. And you have to indicate the methodology for your transfer pricing that has been elected to be used. To the extent that management and administrative fees charged to the subsidiary are unreasonable, that portion of the fees would not be deductible by the Canadian subsidiary and would be treated as a dividend and would be subject to withholding tax. Now, there is no withholding tax on interest that is paid to arm's length non-residents, in other words, non-related non-residents. However, withholding tax on non-arm's length related party interest still applies. And the rate of withholding tax, again, is 25% for interest, but if there is an applicable treaty, it is reduced to 10%. Now, payroll tax. Oh, sorry, one other thing that I want to talk about before we move to payroll tax is thin capitalization. So thin capitalization is another way in which corporations can, parent corporations can provide funds so it's potentially debt that is made available to loans that are made available to a Canadian subsidiary. And usually related interest charges on such loans are deductible by the parent and can be used to repatriate profits on a pre-tax basis, because the interest charges are going to be deductible to the subsidiary. However, the ability to finance Canadian operations with debt is limited by the thin capitalization rules in the Income Tax Act. And these rules serve to limit the deductibility of interest by a Canadian subsidiary where the subsidiary has a high level of debt owing to foreign shareholders or related non-residents relative to the level of equity. And this ratio, the debt to equity ratio, is 1.5 to 1. Anything in excess of that ratio will restrict the interest deduction available to the Canadian subsidiary with respect to interest payments made on non-arm's length debt. So I'm not going to spend more time on that because it's a complicated subject and we don't have a lot of time, but I just wanted to raise that. Okay, just let me see if there's anything more. So payroll taxes, we've talked about a little bit. If you are, and I will talk about a little bit more in a later slide, but essentially if you are carrying on business through a subsidiary and you have employees as opposed to independent contractors or consultants, then payroll taxes are going to be payable by the subsidiary corporation. And those payroll taxes are income taxes, contributions to Canada Pension Plan, employment insurance, and employer health tax in Ontario if the corporation is required to pay that. Finally, we just want to talk about filing requirements. So a Canadian subsidiary is required to file an income tax return annually. It's required to maintain books and records at its location in Canada or at a designated location, and is required to comply with all of the filing and reporting provisions and retention of records provisions in the Income Tax Act. Okay, so before I move on to the next section, I'm going to see if there's any questions on this part. Anybody? Any questions? Nathaniel, are there any questions for me so far?
Hi, Sabina. There was just one question, but Taras graciously answered it in the chat.
Okay.
So I think it should be fine, but just to mention it so everyone could hear it. The question was from Sandro, and he mentioned, can I open a federal partnership in Canada in the context of, as a lawyer? And Taras, had answered that in saying that, partnership legislation is governed by the provinces and there is no federal partnership legislation, unlike Canada Business Corporations Act for legal consultants in Ontario. But however, we have helped foreign lawyers obtain this designation and incorporate a company in Ontario at our firm. And if you'd like to add anything to that, Sabina, please go ahead.
No, I think that adequately covers it.
Awesome.
Okay, so moving on, we're going to talk about goods and services tax. So goods and services tax, or excise tax, is a value-added tax, and it's a tax of 5% that is imposed on goods sold or rented and services that are provided in Canada. Non-resident corporations with a permanent establishment in Canada are deemed to be resident in Canada for the purposes of GST, and may be required to register and collect GST on all taxable supplies of property and services made through their permanent establishment. And I'm going to talk a little bit more about that now. Okay, so GST versus HST. You may have seen these terms if you're doing any business in Canada and you're receiving invoices from Canadian suppliers with respect to work that's carried on in Canada. And essentially the GST is the federal portion, the 5% portion, and provincial sales taxes are for the most part, harmonized across Canada. There are a few exceptions. British Columbia, for example, has a separate provincial sales tax that they impose. In Ontario, we do harmonize GST and HST, GST with the provincial portion of sales tax, and that's called harmonized sales tax, or HST, and it is collected and administered by the CRA, the federal government. Okay, so again, we're back to this term of carrying on business in Canada. And there is a different, because it wouldn't be Canadian tax without different rules. There's a different set of criteria for carrying on business in Canada for GST purposes as opposed to carrying on business in Canada for income tax purposes. So we'll start first with just the basics about GST and who's required to register and collect HST. So if you're a non-resident person and you carry on business in Canada, you are required to register for GST if you make a taxable supply in Canada. And I'm going to go through all of those terms in a moment. So what is a business? A business, that the factors that are considered in determining whether a non-resident person is carrying on business in Canada for GST or HST purposes include the place where agents or employees of the non-resident are located, the place of delivery of the service, the place of payment for the service, the place where purchases are made or assets acquired, the place from which transactions are solicited, the location of assets or an inventory of goods, the place where the business contracts are made, the location of a bank account, the place where the non-resident's name and business are listed in a directory, the location of a branch office, the place where the services are performed, and the place of manufacture or production. So as you can see, again, is very, very fact specific. I mean, there are general rules that have been developed in both technical commentary by the Canada Revenue Agency as well as case law. But the importance or relevance of any given factor in a specific case will depend on the nature of the business activity under review and the particular facts and circumstances of each case. So it's quite fact specific, subject to kind of general rules of application. So basically, if you're carrying on a business in Canada, and if you have a subsidiary in Canada and you provide services in Canada, you're deemed to be carrying on a business for GST purposes if you're providing taxable supplies. So what is a taxable supply? So most property and services supplied in or imported into Canada are subject to GST or HST. The general rule under the Excise Tax Act is everything is taxable unless it's not. And that's not a very helpful rule. Welcome to my world, but that is essentially the rule for ETA purposes. Assume it's taxable unless it's not by virtue either of a specific exemption or it is a zero-rated supply. A zero-rated supply is a taxable supply, but taxable at 0%. And I'll explain that wonderful tax conundrum to you in a moment. Taxable supplies, here are some examples. Sales and rentals of commercial real property, sales and leases of automobiles, car repairs, taxi or commercial ride-sharing services, publications such as books, magazines, and periodicals, the rights to operate franchises, and hotel accommodation. Those are some examples. And of course, more common examples are things like carrying on a professional services practice, such as a practice of law or accountancy, and offering anything for sale that is not either a zero-rated or an exempt supply. So zero-rated supplies, what are these? They are taxable supplies, but they're taxable at a rate of 0%. So what does this mean practically, and why on earth would this be even, contemplated? It's because we have a system in Canada with respect to the excise tax that allows you to claim what's called an input tax credit for taxable supplies that you yourself incur in the course of carrying on your business. So if you are carrying on business and making zero-rated supplies, but you pay GST in the course of providing that service, you can claim an input tax credit back to either receive a refund of HST if all you provide are zero-rated supplies, or to reduce your total HST payable if you provide a mix of taxable and zero-rated supplies. So what are examples of zero-rated supplies? Basic groceries are not subject to GST, bread, milk, eggs, that sort of thing. Agricultural products such as wheat, grain, raw wool, dried tobacco, these are not subject, these are zero-rated supplies. Prescription drugs and drug dispensing services are also zero-rated supplies. So if you are engaged in these types of businesses, you are subject to GST, but at a rate of 0%. And then there are exempt supplies, and these are supplies that are exempt from tax altogether, from GST altogether. Primarily, these are most medical, health, dental services. Certain medical devices are zero-rated. Most medical devices are not zero-rated, but for example, a hearing aid would be a zero-rated supply. So just on the medical front, most medical, health, and dental services are exempt, provided that they are being performed by a qualified licensed health professional. So dental services provided by a dentist, exempt supplies. No GST is charged with respect to those services, and no input tax credits can be claimed. Most educational services are also exempt supplies. So if you are a university or a training facility, those types of services are exempt from the imposition of GST. In addition, most services provided by financial institutions are exempt supplies. Okay, so registration requirements. So you have to register for GST if you provide taxable, including zero-rated supplies. You make taxable supplies in Canada, of admissions for a place of amusement, a seminar, an activity, or an event held in Canada. You sponsor or host a convention in Canada and more than 25% of the delegates are Canadian residents. You solicit or offer for sale in Canada books, newspapers, magazines, periodicals, or similar printed publications. So in those circumstances, you must register for HST. Companies, corporations, partnerships register for the GST as single entities. Branches and divisions usually cannot register separately for HST. So if you are carrying on business in Canada through a branch, the foreign parent or the non-resident company will have to register in Canada for GST or HST. You do not have to register if you are a non-resident who does not carry on business in Canada, or if you are a non-resident who sells taxable real property located in Canada other than in the usual course of business. So in other words, if you're in the business of buying and selling real property, you do have to register for HST. But if you sell taxable real property, you're a non-resident, you own a home or another piece of real property in Canada and you sell it, you don't have to register for HST in those circumstances. You also don't have to register if you are a small supplier. A small supplier is a person or an entity that meets one of the following conditions. You're a sole proprietor and the total amount of all revenues is $30,000 or less. You're a partnership or a corporation and the total amount of all revenues is less than $30,000. Or you are a public service body, in other words, a charity, a not-for-profit, an educational institution, so on, and the total amount of all your revenues is $50,000 or less. Now, there's more nuance to these rules, but this is the general rule for the purposes of this seminar. So it's $30,000 for individuals and corporations or $50,000 for a public service body. If you provide taxable services that are below those thresholds in a year, you do not have to register or charge HST or GST. So filing requirements. When you register for the GST, you are assigned a reporting period depending on your estimated revenue. So you could be a monthly filer, a quarterly filer, or an annual filer. And it's based on, again, the total revenue from your taxable supplies. Filing and remittance due dates will also be based on your reporting period. For Canadian tax purposes, amounts collected with respect to GST and HST are considered to be held in trust for the government, for the Crown. So if there is unremitted GST, then directors of corporations may be held personally liable for such unremitted amounts. And the CRA takes the collection of unremitted HST very seriously, again, because these are considered to be trust funds. So even if you were to dispute the amount of GST that's been assessed to you, and you were to file a formal dispute with the Canada Revenue Agency, there is no halt on attempted collections actions with respect to such amounts. So the CRA will continue to try to collect, notwithstanding that you may have filed a formal dispute process with the CRA with respect to the calculation of such tax. In addition, penalties and interest may apply for late filed and returns and unremitted GST and HST. There is a requirement, of course, to maintain adequate books and records by every person who carries on a business or is engaged in a commercial activity in Canada. And these books and records must be kept for a period of about 6 years. Are there any questions with respect to GST? Otherwise, we're moving on to payroll tax, and I'm mindful of the time.
Hi, Sabina. A quick question from David. His question is in regard to the taxable supplies, and his question is, does honey or propolis considered zero rated?
So the short answer to that is I don't know. I'd have to look it up. So the regulations do have a list of zero rated. They're in the Excise Tax Act, so I can look it up and get back to David on that. But I'm afraid I don't know the whole list off the top of my head. I'm sorry.
That's okay. I'm sure that's a specific question, but thank you.
Yeah, but I will look it up and I will get back to, if you could just let me know if David could provide his contact information, or we probably already have it from the registration. I'll get back to him directly.
For sure.
Okay, so we've already covered payroll taxes, and so I'm not going to spend a lot of time on this. I'm just going to talk about one that's specific to Ontario, which is employer health tax. So as previously discussed, the employer is responsible for remitting both the employer and the employee portion of Canada Pension Plan and employment insurance. And, you know, these are relatively self-explanatory. Taras already talked about what employment insurance is, and Canada Pension Plan, again, self-explanatory what it is. It's our Social Security for our US friends. Now, employer health tax is something that is levied in Ontario. It is a payroll tax. And it's a payroll tax on remuneration paid to employees and former employees with respect to healthcare in Ontario. So healthcare in Canada is provincially administered, and employer health tax is a way to try to get extra revenue with respect to our employee provision of healthcare services in Ontario. So EHT is payable if you're an employer and you have employees who physically report to work at your permanent establishment in Ontario. You have employees who are attached to your permanent establishment in Ontario. In other words, they may not physically report, but they have a connection to. Or you have employees who do not report to work at any of your permanent establishments, but are paid from or through your Ontario PE. So the bottom line here is, if you have an Ontario permanent establishment, you're likely going to be subject to employer health tax, or have a requirement to pay employer health tax. However, there is an exemption amount And that exemption amount is $490,000 of total remuneration paid. So if your total remuneration paid to your employees is less than 490 or less, then you are not subject to make employer health tax contributions. And that number was increased in 2020 due to COVID to $1 million exemption amount before EHT is exigible. Like GST, directors can be held personally liable for unremitted payroll taxes. And like GST, unremitted CPP and employment insurance premiums are considered to be held in trust for the Crown. And so there is quite aggressive collections actions and enforcement actions for unremitted payroll contributions, and directors can be held personally liable for such unremitted payroll taxes. There is a due diligence defense available if you are assessed personally as a director for unremitted payroll taxes. Usually the CRA is required, or not usually, they are required to show that they have taken every attempt to collect from the corporation before seeking to assess a director personally for such unremitted payroll taxes. Okay, moving on, we're going to talk about withholding tax. So I've already covered the 25% withholding tax, and I don't intend to cover that again. Again, we've covered it in the context of branch and subsidiary payments that are being made back to a non-resident parent corporation. So I wanted to talk instead more about Regulation 105, withholding. And this applies to a branch operation. So Reg 105 is a regulation that, it's a regulation which provides that payments received by a branch for any services rendered in Canada are subject to Reg 105 withholding. And this Reg 105 withholding tax is on account of any applicable Canadian income tax payable by the non-resident by reason of carrying on business in Canada. This tax is equal to 15% of the amount paid to the branch for services rendered in Canada and is required to be remitted to the CRA by the person or entity paying for the services of the branch operation. In other words, somebody who is making a payment to a Canadian branch for services rendered in Canada is required to withhold and remit this 15% withholding tax. Regulation 105 withholding is administratively burdensome for payers who are dealing with non-residents and carries with it significant penalties that can be actually assessed to the payers themselves. Payments required under Reg 105 are due on or before the 15th day of the month following the month in which the payment was made. And the payer must prepare and file a T4A and or information return reporting all amounts paid to non-residents for services provided in Canada, and must be filed by with the CRA by the last day of February in the year following the year in which the amounts were paid. The non-resident corporation can generally obtain a refund of the tax withheld based on a treaty exemption. If the non-resident corporation provides services as opposed to goods to Canadian resident customers, it is usually preferable for a Canadian subsidiary corporation to be utilized rather than a branch in order to avoid Reg 105 withholding tax issues. It's just something to be aware of, another complexity in using a branch of Reg 105 withholding. And then I touched on this briefly, and I don't think I want to spend, given that I'm already over time, any more time on it. I'm just going to remind you that under the thin cap rules, the debt to equity ratio is 1.5 to 1. So any debt in excess of that ratio, the interest on such debt will not be deductible by the Canadian payor, Canadian subsidiary. Okay. Treaties. Again, I'm not going to spend a lot of time on this other than to highlight that we do have a significant number of treaties in place. There are, I just checked this morning, 94 tax treaties in force, 3 signed but not yet in force, and 8 that are under negotiation or renegotiation. The biggest benefit, of course, of treaties is that they serve to eliminate double tax and reduce withholding tax. They also provide foreign tax credits so that any taxes paid in Canada can be claimed by the non-resident with respect to tax imposed in the country of the non-resident for the same that same income. A tax information exchange agreement I wanted to talk a little bit about because it's something that is unique. Well, I don't know that it's unique to Canada, but Canada's treatment of taxes with respect to tax information exchange agreements is quite interesting. So a tax information exchange agreement, they've been around since 2011 here in Canada. There are approximately 23 in force. There may be a few more now, but they are primarily with tax haven countries. And so many of you may remember OECD setting out a blacklist, and there were lots of attempts made. The Panama Papers, of course, exposed the extent of offshore activities and tax avoidance. And so there's been a great push to kind of whitelist some of these otherwise blacklisted countries and try to regularize relations between those countries with respect to the exchange of information. So a TIA is exactly what it sounds like. It's a bilateral agreement that allows for the automatic exchange of information between multiple jurisdictions. So rather than on an on-request basis, which requests did not necessarily have to be complied with, signatories to TIAs have an automatic exchange of information with Canada. And some of the information that is shared is information relevant to the determination, assessment, and collection of taxes, the recovery and enforcement of tax claims, and the investigation or prosecution of tax matters. So essentially, a TIA is intended to help enforce Canadian tax laws, or help Canada enforce Canadian tax laws and tax evasion, because most of the countries that have TIAs signed are either low tax or no tax jurisdictions. So it's all really for the benefit of Canada to have TIAs in place. As part of a carrot or encouragement to have countries sign TIAs, Canada encouraged foreign countries by extending favorable exempt surplus regime to foreign affiliates. So if you look at point 5, repatriation of profits, if you're carrying on business through a company in a foreign tax haven jurisdiction, Cayman Islands, Barbados, well, Barbados doesn't count because it has a treaty and it's a low tax, but not a no tax jurisdiction. So we'll pick on Cayman Islands. So Cayman Islands is a no tax jurisdiction, no income tax jurisdiction, but they do have quite a robust economy with respect to a lot of businesses and services carried out of the Cayman Islands. So if you were a Canadian company and you had a foreign affiliate in the Cayman Islands, and it carried on business and wanted to repatriate its profits, absent a TIA, there would be withholding tax on the repatriation of those profits. So because Canada and the Cayman Islands have a TIA signed, Cayman Islands companies are able to repatriate exempt surplus, which is profit, essentially retained earnings from an active business carried on in that country. They're able to repatriate those profits tax-free to Canada using the exempt surplus rules. So this is a great advantage as far as being able to repatriate profits for businesses being carried on in otherwise tax haven countries. And that's all really I want to say about that. The last slide has nothing to do with tax, and I'm not going to spend more than like 1 minute on it. I just wanted to advise you of its existence. The Investment Canada Act is something else that has to be considered in the course of either establishing a new business in Canada or acquiring a Canadian business. And I don't know if Joseph is maybe going to cover it in more detail. Essentially, again, in my 30 seconds that I have left, there is a review process. Now, the thresholds are very, very high for even being subject to the Investment Canada Act. I think it's $1.5 billion or $1.25 billion of investment. And so in most cases, this will likely not apply unless you're proposing to carry on a business in Canada of that magnitude. But there would have to be compliance with the Investment Canada Act, either through a notification of an investment or an application for review, which is a much more expansive process. And it applies in respect of a Canadian business, which is defined as a business carried on in Canada that has a place of business in Canada, an individual or individuals employed or self-employed in connection with the business, and assets in Canada used in carrying on the business. And again, I'm not going to spend any more time on it, but just wanted to highlight this as something that you should be aware of with respect to setting up operations in Canada, that you may need to comply with the provisions of the Investment Canada Act. And with that, I am happy to take any questions that you may have.
Awesome. Thank you very much, Sabina, for all that critical information. Let me just see if we have any questions here. I think we have one question from David, we got some more. His first question is there a TIA to repatriate profits from Mexico?
I think there is a tax treaty with Mexico.
Okay, awesome. And then got one more question and lost my chat box here. No, I think we're good. Okay, great.
Okay.
Thank you very much, Sabina.
All right, thank you.